following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host for the show, David Blain. We thank you for joining us today on 94.1 FM, WNBU, and Cable TV 10 in New Bern. We're also streaming on the internet from our website, www.dlblain.com. We get all our ideas for the show from you, our viewers and listeners. So if you have comments or questions, topics you'd like covered, please give us a call. Our phone number is 252-633-0107. You can also email us at allthingsmoney@dlblain.com. And of course, you can visit us on the web at our website, www.dlblain.com. There you'll find information about myself, my firm, and as well as archive copies of the show. We're currently in the process of revamping our website. We have years and years worth of articles that we've written, videos from the TV show, audio from the radio show that we're cataloging to create a searchable index. So if you want to search for a topic, say stock market, you can type it in, and we're developing this whole knowledge center. So it's great. We're very excited about it. It should be rolled out pretty soon, so we'll keep you updated on that. Today we want to talk about a few things. The first one I thought I'd talk about, in a low return environment such as we're in today, dividends become an important part of an investor's total return. They always have been. If you look back historically, at least in the United States, the dividend yield on investments on the stock market has averaged somewhere 3 to 4%. You factor in a 3 to 4% inflation rate, and then the remainder of the return comes from the expansion of the PE. But let's suffice to say a good portion of the return historically has come from dividends. And today, despite historically lower dividend yields, somewhere in the 2.5% range, they're still a very important part of the return, especially when it comes to fixed income investments. These investments return some sort of interest income. If you're investing in a mutual fund or something like that, they are considered dividends, interest income dividends. One of the things that you want to look for when you're comparing returns of investment is making sure that what you're looking at incorporates the return of the dividends as well as interest. One of the things that I see quite often, both on the internet, if you go to, say, Yahoo Finance, which is one of the best finance websites out there, or Bloomberg, or CBS Market Watch, or even on TV, CNBC, things like that, most of the time the charts and data that are presented for you to look at are what we would call a price return only chart, and they exclude the impact of dividends. For example, we looked at a period of 10 years from October 2001 to October 31, 2011. We looked at a stock investment in the U.S. stock market as well as an investment in the U.S. bond market. And if you pull up this chart on Yahoo Finance, you see that the total return for the stock market was about 27%. The total return for the bond market was about 7%. And so you would naturally assume that over the past 10 years, the bond market outperformed the stock market by a wide margin. But if you don't realize that these charts don't include dividends, you're going to come to a very wrong decision. If we look at including dividends, the reality is the bond market over the past 10 years returned a total return of about 66%. The stock market's return also went up from 27 to 58, but the bond market actually outperformed the stock market the past 10 years, and you probably know this already intuitively, but by looking at some of the charts and some of the return data that's out there on TV and the internet, you may not realize it. So it's very important to make sure that you are looking at what we would call total return indices, and these are indexes that or performance computations that include the computation of dividends and interest. That if you're just looking at price only, it will unduly penalize anything that pays a large dividend. Some other investments, for example, master limited partnerships, which are most of the oil and gas transmission in the United States is organized into these master limited partnerships that own all the transmission pipelines. Well, they tend to pay large dividends as well, on the order of 6-7%. And so if you look at just the price appreciation of those, it also gives a false impression of the true growth. So remember, the total return from investment includes the return from price appreciation as well as return of dividend or interest income. And so make sure that you're looking at a total return investment. The same thing when you're looking at your portfolio versus you say, well, how did my portfolio do versus the stock market? A lot of times you will see, for example, the S&P 500 quoted as a price-only return, not accounting for the dividends. And these are a big portion of the dividends. An even better way to look at it, or an alternative way, is to look at what we would call the growth of $100, where when presenting the performance, instead of looking at the total percent return, you look at, well, how much did $100 grow to, or $1,000 grow to? And this will give you what's called the geometric return, which is a very good way of looking at returns. One of the other things I want to mention when looking at returns for foreign investments is you have to know which currency you're talking about. Are we talking about the return to a U.S. investor? Are we talking about the returns in local currency? For example, if you are a U.S. investor and you invest in, say, China, and the companies in China go up in value or down in value, but then in order to spend that money, it has to be converted back to the dollar. So you have a currency factor involved in that investment. Now, if you're looking at the returns of a U.S. mutual fund or U.S. ETF or something like that, they're virtually all going to be quoted in U.S. dollars. But where you run into some problems is when you're looking at the indexes. For example, the MSCI EFA index, Europe, Asia, Far East index, or the MSCI China index. It's very important that you understand, if you're looking at the returns of that index in U.S. dollars or in the currency of that foreign country, because it can make a big difference. If you have an investment that goes up in value and the dollar also declines in value over that same period of time, your returns are going to be much higher. You could actually have an investment in the China index, for example, say go up in price terms, but if the U.S. dollar appreciated against the yuan, then your total return could be zero or even negative in U.S. dollars. So it's important to know what type of returns you're looking at. Well, that brings us to our first break. When we come back, we have some more interesting topics to discover. So for All Things Money, I'm your host, David Blain.